Let's start with our a very interesting discussion lined up with Mr. Santosh Navlani on to buying of a life insurance. So buying a life insurance can be actually a really tricky affair because many people do not feel the need to be insured, and those who do may not go through the nitty-gritties of the life insurance policy, and thus life insurance, like so many other things, takes the shape of a push product where insurance agents convince and even lure people into buying a life insurance. Now, this is where you as a customer are most likely to fall into a trap. Now, on to the ET Money show today, we'll tell you how a life insurance is missold and how can you avoid walking into such traps. Let's bring on board Mr. Santosh Navlani, who is the COO of ET Money. A very good evening, Santosh, and thank you for joining us today on ET Now. So the topic is very interesting and very connecting as well, because this is a phenomena that we see happening to the general public. But when it comes to personal finance planning, one of the key blocks is buying insurance specifically, that is for health and life insurance, right? But can you tell us, viewers, why is that so?
Hi, Srishti. So I think, as you mentioned, this is possibly one of the most interesting topics to talk about and actually educate almost every individual out there in the marketplace. While we all believe and keep recommending that the first thing in financial planning is you should actually have your health insurance first. Not everybody requires life insurance very early in the life stage that one individual is in. At least not the moment he starts earning money, he or she, or at least when they don't have dependents on them. So life insurance can come later. The first and foremost important product to buy is health insurance for everybody, because be it a healthy individual, a young individual, or elderly, everybody and anybody can get surprised by the life's exigencies, and medical emergencies can knock on door unannounced completely, and they actually can play havoc on your finances if there is hospitalization required, or any kind of surgery required, or any kind of unplanned medical complication comes into your life. So the fact is, health insurance must for everybody. Life insurance is not, at least not in the younger age, for everybody. And once you understand at what point of time you need to buy life insurance, you also need to understand what kind of life insurance not to buy. In fact, the word life insurance basically misguides a lot of people into buying investment come insurance policies, and the name convention is itself life insurance. So people actually get kind of looted in that aspect a lot, in my opinion. So understand first of all that what kind of policies you require at what stage of life, and only then go about researching them, buying them, and possibly continuing to pay premium for them if at all you understand them.
Okay, but very interesting point made there, Santosh, that health insurance is very necessary right now, but life insurance is not. But what we see happening is that life insurance is actually missold, because we see a lot of people who don't have that great a knowledge about this particular product, and they are being forced, because with a caveat that everyone has to die and this is something that can actually help their families. But you have been reading so many cases, but why is life insurance being missold, and what are the factors that are triggering this mis-selling?
So I think it cuts both ways, Srishti. I think the fact is most consumers need to be educated that insurance is not an investment; it's an expense. Till the time the customer has any inkling that insurance is an investment and need to get money back if the eventuality doesn't happen, and he or she needs to understand he's not then expecting to buy an insurance policy. That person actually is looking to buy an investment policy. In the moment intermediary, an insurance agent, a bank RM actually detects this weakness in the customer, that he or she is looking to actually to do insurance not as an expense item but an investment item, he or she can present plethora of options in front of customer which can look quite attractive on the face value, and that's the customer's fall flat. So I would say it's a miseducation or lack of financial literacy in the customer end that he or she needs to look at insurance as an expense, and not investment ever. And the meaning for that is an insurance policy should pay you only in the event when things that you bought insurance for actually happen in life. For example, if you bought life insurance, that means your family needs to get a maturity or a sum assured payout only on in the event of one's death and not otherwise. The moment it is claiming to give you money, even if you're alive at the end of the policy maturity period, that means it's an investment policy. And I think one biggest thing that Indians get possibly misguided into is why to pay a term insurance premium when you know that it's very unlikely that you would die in 20 years of your life, and so your entire premium is going to go for waste. Instead of that, buy some kind of policy which at least gives you some money back if you don't die. I think most people fall into this trap, and the moment they stop falling into this trap, the mis-selling will stop.
Well, Santosh, but would like to get some more details on, because what people think is that the money can only be transferred into the account when that person is no more. But you did touch upon that you can actually relate this to some of the returns expectation. If you could just tell our viewers that which are the products that they should be looking on and what kind of return expectation they can have from it.
So see, that's a fact of the matter here, Shishti. The moment you say that you want returns from insurance policies, that's where people get misguided. And here are some examples how they get misguided in this. So sometimes an agent would actually look for a customer who typically is looking to get some money back at the end of policy maturity period. And one of the most oft repeated things is that you invest, say, 1 lakh rupees every year for 10 years. And from 11th year onwards, you start getting 1 lakh rupees for life, or 1 lakh rupees for about 2 decades or 15 years. Now, what happens is you basically, as a customer, are looking for some kind of passive income every year hitting your account for long periods of time. And you get attracted by this kind of proposition that I'm putting 1 lakh rupees only for 10 years, but possibly I'll get 1 lakh rupees for 20 years in that sense. And if you do the math around it, the returns on the internal rate of return basis, the XIRR of this kind of policy would be only about 4.5, 5.5 percentage points. And what people don't understand, that insurance company will take this 1 lakh rupees, will do, and your money will be locked in for 10 years completely. This 1 lakh alone can actually grow to like 18 lakh odd rupees at 6% CAGR in 10 years. Now, this amount can easily be funded for your own self for 18 years if you are doing on your own as a customer beginning in bank FD. But what happens is the moment it's pitched as a life insurance policy, that you will also get benefit of a death benefit. If you die in the policy paying period, your family will get this, and you will get the policy maturity value, and all those kind of things come into picture. People get attracted by it and fall for it. Otherwise, there are another example where what people do is they come and tell you that there is a money back policy. So you put money for like 12 years, and from 14th year onwards, your 1 lakh rupees paid per year for first 12 years, they start giving you say 1.35 lakh rupees for 5 years, then possibly it'll go to 2.6 lakh rupees for next 5 years, and then you will also get kind of 2 lakh rupees extra towards end of the premium period, which is like 25th year from now. So technically speaking, you're putting 12 lakh rupees and getting 22 lakh rupees in 25 years. It is quite a misleading investment, again earning only an IRR of 5% odd. Now, 5% odd of return you can generate by putting money in bank FD. You can generate higher money by putting money in PPF. And of course, when you look at tax-saving mutual funds or any kind of mutual fund, the fact of life is Nifty has given 12% CAGR over last decade or so, and long-term returns in the region of 11-12%. So why would you want to block your money earning 4 or 5% interest rate when you can earn higher returns? The problem is that people actually fall for larger values. Mutual fund companies don't communicate that if you invest in SIP of 10,000 rupees, here is what you can expect after 20 years. But insurance companies are allowed to do so, and that's where people fall flat, in my opinion.
Well, yeah, well, yes, that is one case in point where people fall for this particular trap. But Santosh, another trap is by the insurance agents as well, because there they say that if you take the policy, we'll just refund the first or the first two odd premiums that you actually paid, and they do cut that amount from the premiums that they receive as commission. So just wanted to understand that why is this kind of a scenario that is happening right now, and what should people be wary of?
Yeah, so I hit the right point, Shishti. I think many people get caught into this. I think typical approach here is if an agent is able to convince a customer to buy a non-term life policy, like an investment cum insurance policy, and the annual premium that he can cough up is say 20,000 rupees or 30,000 rupees, and agent believes that the customer actually can afford to pay 50,000 rupees annual premium. So can I increase my ticket size? And the moment he sees an opportunity, he typically will offer you that you're struggling to really pay the entire premium this year, but I'm sure next year you will be able to pay this premium easily. And the customer says yes. So he says that I will actually refund a part of or full part of the first year premium to you after the policy gets issued. And that's where what happens is customer needs to understand that if an agent is actually able to give me almost entire first year premium or a large part of first year premium that I'm paying into my bank account after the policy issued, look at the kind of commission that agent must be making. I think people don't think like that because the agent is not going to put money from his pocket. He's going to earn that money as commission and giving you back. That means a product which actually has such large commissions involved is not actually putting your money to work, is actually putting the money to work for insurance and the agent in picture. So as a customer, you need to be more, take a step back and understand how can somebody having such kind of commissions if it is actually a beneficial product. And a second aspect in this, people also, sometimes some customers are well read and they will actually come and say that I actually want only term life insurance. I don't want anything else. An agent will actually spot an opportunity where he will actually try to increase his ticket size and say that why you're actually buying term life insurance. If you don't die, all the money will go for waste. Buy something called as return of premium product, which means that whatever you pay as premium for 20, 30 years of your life, you'll get it back if you don't die. And most people get attracted to it and they don't look at the fact that the premium here are multiples of what the premium would be if you opt for a non-return of premium product. And so I think agents or any kind of intermediary, the moment he spots an opportunity to actually secure a higher income or a larger commission, they would start making these kind of promises and misguidance to you, even if you want to be more vigilant about these products.
Understand, but Santosh, we did touch upon a lot of factors that why is this mis-selling is happening and what should points you should be taking care of. But lastly, would like to touch upon like how as a customer you can take care that you are not being sold any of those life insurance policy which you actually don't require. Which are the points as per you that a buyer should be taking care of?
So I think make it very simple, Shishti. I think set a golden rule that you will not buy an insurance policy which actually claims to pay you some money at the end of policy period if something doesn't happen to you. So if you're buying a life insurance policy, it's a 20-year paying term, and there is a maturity benefit coming in the end of the policy period that if you are still alive after 20 years, you're going to get your some money back, be it small, be it big. Don't buy that policy because two things will happen. Your annual premiums are going to be far, far larger. Your sum assured or the life cover that you'll get will be far, far lower. So set one golden rule. Second is understand if you really want to buy some kind of benefit policy, do the calculation on an Excel, understand what is the IRR for this policy. Anything earning less than inflation or at least 1% real return is a straight no-no. So for example, if you do the math of an endowment policy or a money back policy and you see that IRR of this policy is less than inflation, say 6%, just reject the policy immediately. And if you see the IRR is actually coming above inflation, see if it is actually at least 1 or 2% real return, and if it is guaranteed. If it is guaranteed and you think you are falling for 1 or 2% real return, which you possibly can earn far more in mutual funds or any other investment product, and you still want to buy this, go ahead and do it, but do the IRR calculation. Doing IRR calculation will actually open up a wider canvas of products for you, which may be more suitable to you, and just go and buy a term cover instead.
Understand. Thank you so much, Santosh, for sharing that golden rule. What should you be taking care of when you are pitched for a life insurance policy? It was great having you on the channel. Thank you so much for that.
Thanks, Christy.